I already have a data center REIT in my portfolio, but I've actually made further purchases into this sector via this particular REIT. Currently, at my purchasing price is about 4.8% in dividend yield. So the question is, why did I make this purchase, correct? If you're curious, continue watching on. Hi guys, welcome back. Without further ado, let me introduce to you Keppel DC REIT. Today I'll be starting this whole discussion by sharing with you big picture trends. And in the second part of the video, I'll be moving on to some data points whereby Keppel DC REIT actually shared operational numbers for first half 2023. Stay right to the very end also because I have a shocker for you as to how I've actually made this purchase into Keppel DC REIT. Smash the like button early because you know I have the goods. And let's start with the big picture point. This is reflected in its first half 2023 report. Growth in generative AI applications such as ChatGPT and Bard will accelerate demand for data centers. Sounds very logical, correct? Everything you see nowadays on the internet is all about AI and ChatGPT's breakthrough to revolutionize how we actually do search and how we can actually tap on AI even as individuals. This is first layer thinking because while this could be a mega trend that will happen in the next 5-10 years, the second layer thinking is to remember how many times we have seen fluffy words like this before. Previously, it was virtual reality and metaverse. 3 years ago, even in Keppel DC REIT's report, is mentioned about cloud infrastructure and digital economy. Now, how can we be so sure that this whole AI revolution will not be just a novelty that we're aware of? Will it grow indefinitely or not? Or which are the shining spots that would be the best bets? Nobody knows for sure because if you think ChatGPT is going to the moon, latest readings have discovered that ChatGPT has actually seen declines in usage. That is the blue line at the top over there. First decline in monthly visits for June 2023, and could it be just novelty wearing off or competition? What we can see at the bottom is Bard, which is owned by Google, and that is eaten the market share. But again, from this interpretation, we can see AI usage on a month-to-month basis did not surge as much as 6 months ago. That's why there's this wisdom that we need to remember when we are investors. During the gold rush, most would-be miners lost money, but people who sold them picks, shovels, tents, and blue jeans made a nice profit. Today's goal could be AI or cloud computing or digital economy. All of this require data centers. That's why being invested there for the long term definitely makes sense. On the short to medium term also, stock prices appear to me at least to also may have bottomed. Back in November 2022, it bottomed around 150, 160. And then in March 2023, indicators for stock prices have also turned bullish. As always, stock prices are looking ahead. And while they may have bottomed, near-term results may still see some headwinds. Keppel DC REIT reports stable first half 2023 DPU of 5.051 cents. And don't worry, I'll drill into details in the next section. But before that, let me introduce to you today's sponsor, who is DH Singapore. I'm a subscriber not only to a digital format, but also the print format. And this is actually a very relevant topic. REIT fees, flight or fight. Within it, you'll see this article over here that mentions very specifically on a lot of key things that we as investors need to be aware of. There's a segment that mentions on the alignment of your REIT manager, and as always, we've seen some REITs capitulate in terms of share price very recently, but the strong ones have better alignment and better support from its sponsor. If you prefer digital format, let me show you what this annual subscription with DH Singapore would deliver for you. You would see over here that this is a premium article, and if you unlock it, you will realize you can read the full breakdown as well as click on this very unique link over here. This gives you in Excel format what you see in the table over there, just in case you want to modify it and adjust it to your own requirements. Not just that, you will be able to see previous premium articles and those that are coming soon. So if you're keen, check out our offers for today, which is a 15% discount for the annual subscription. Not only will you get it for the digital format, you can also get it if you prefer the digital plus magazine format. At the checkout counter, input my referral code JOSH TS, which stands for The Edge Singapore 15, and you will receive 15% off by subscribing for this limited promotion. Pause the video if you need and check out this offer right now. Thank you for supporting the channel, and let's move on to the next segment, which is the good and bad of some results coming up for first half 2023 that Keppel DC REIT has recently declared. Let's go with the good portions first. Naysayers will say that interest rates are still climbing, REITs will crash. There is a lot of concerns on that, etc, etc. But if you are already invested in Keppel DC REIT, let me share with you some latest updates to comfort you that things look still quite healthy, at least from my perspective. Keppel DC REIT has about 73% of its loans fixed. And not just that, the important part is its debt maturity profile shows that the bulk of them need refinancing only in 2026 and 2027. If interest rates stay high for the next 1 to 2 years, no issues, it's still pretty healthy. And if we were to scrutinize, we'll see the average cost of debt because of its recent refinancing has actually inched up by 50 basis points. That's still quite a lot, but still better than many REITs out there. Later I'll come back to touch on this point specifically. Interest coverage ratio is about 6 times, which looks good, but it was once 8 or 9 times. All in all, still a healthy ratio. Then let's move on to the not so good portions. Stable DPU, correct? Stable sounds nicer. So let's quantify what exactly stable means. It's mentioned that its China recent investment, Guangdong Data Center, has contributed. That sounds good. It's gotten some renewals and income escalations. By right, based on this point, I'll expect revenue to grow, which it did if we compare first half 2023 to 2022. But if we compare quarter on quarter, we realize that first quarter 2023 actually clocked $70.4 million, whereas second quarter only clocked $70 million. So there's a drop in terms of gross revenue. Then what about for costs? It's mentioned that higher finance costs from refinancing, that has been mentioned already, and net lower contributions from some co-location assets due to electricity cost. Now this has reflected in the increased property expenses, which impacts net property income. What I've always suggested on the channel is to always focus on net property income because this needs to grow in order for us shareholders to see DPU being stable and sustainable. DPU looks to have trended up if we compare first half 2023 to 2022. However, if we compare quarter on quarter, we will realize a decline in DPU. If we were to map first half 2023 with second half of last year, you would realize that this DPU drop has been ongoing for a few quarters already. Previously, it was at 5.165 cents. Right now, it's at 5.051 cents. If we were to map the last 2 years out, you realize there was a big jump in second quarter 2022. And that's because China Guangdong Data Center 2 has been fully acquired by then. And then ever since then, it kind of slided down a little bit each quarter. This could be explained largely due to interest costs while revenue remained flattish. But take note again, there's still Guangdong Data Center 3. This will be acquired by Q3 2023 and maybe, or hopefully, this could arrest the DPU decline. Smash the subscribe button. Once there are new results coming out, I'll release it and share them with you over here in this channel. That's why as investors, I think we need to be optimistic but also cautious. I've actually made my purchase on Keppel DC REIT before these results were released, and I actually prefer it to Suntec REIT. Not investment advice, but shocker, I've actually cut losses on Suntec REIT to reinvest the entire capital over to Keppel DC REIT. Just a few quick reasons as to why. When I look in terms of Suntec REIT's debt profile, I couldn't figure out how to reduce the leverage. The all-in finance cost is higher and is still climbing at 3.68% already as of 31st March. And the interest coverage ratio is drawing thin at only 2.2 times. If you are keen, let me know in the comment sections for an elaboration on Suntec REIT. I will do my best to produce an episode once they release newest findings. And as always, let me know in the comment sections whether you agree with some of the findings or not. And as always, check DH Singapore today with my referral code JOSHTANBURSARY for 15% discount on their annual subscriptions. As investors, we have always to read widely and learn widely about the changing landscape, and there's always this concern. Do you believe data centers are still good assets? Especially big tech themselves are building their own data centers. This was a question posted at Mapletree Industrial's Q&A session, and it's mentioned also that Jim Chanos, which is a famous short seller, has actually taken a position against data centers. There was an explanation rebuttal made by MIT's management, and if you're keen to hear some of my breakdowns, check out this previous tutorial I've done, which touches on this very concern. Check it out, or if you've seen it already, check out this previous tutorial I've done before. This is regarding residential property in Singapore. There is a very interesting breakdown I've done before on co-living. So if you're curious, check that tutorial out also, and I'll sign off from here. Take care as always, invest safely, goodbye.